Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today's Friday, July 21st, 2023. And in today's video, we're going to talk about some of the economic data that we see. And we're going to talk about whether or not we will see a quote-unquote soft landing. Got some inflation data from last week, as well as we expect GDP data for that'll print next week. So we'll talk about that in just a moment. However, before we get to that, I want to talk about the broader stock market, as well as perhaps what is a better measure of the average stock. So on the screen right now, you'll see several indices and their year-to-date performance. At the top of the screen, you'll see CompX. That is my system's code for the NASDAQ. The NASDAQ is up about 38% year to date. Remember, the NASDAQ is a very tech-heavy index. And we see the S&P 500 is up almost 19% year to date. And we're going to talk briefly about how that is very, very deceptive. What I want to zero in on down here is the Dow Jones Industrial Average. Remember, the Dow Jones Industrial Average, even though it is the most widely quoted index in the news media, and it's the oldest of the main indices that we use, it's only got 30 stocks in it. And those 30 stocks are up about 5.8% year to date. But look at the one right above that. NYA is the New York Stock Exchange Composite Index. And so this is the composite index of the stocks that are traded on the New York Stock Exchange, and that is up only about 7% year to date. So I highlight all of that because there is a very big difference between what we are witnessing in the NASDAQ, the tech-heavy index, and the S&P 500. Both of those indexes are cap-weighted, and I'll explain that in just a minute. But there is a very big difference between what's happening in those two indexes and the rest of the stock market year to date. Now, as we discussed in the monthly market monologue, we're starting to see the tides are changing, that more and more stocks are participating in this rally. So that's good news. But let's talk a little bit about the NASDAQ and this special rebalancing that's going to be happening later today. It was announced just a week or two ago that NASDAQ is going to be doing what they call a special rebalancing of their main index. And this has only happened one other time. And the main reason that they're doing it is because it has become so heavily weighted towards just a handful of stocks. As we've discussed on this channel many times, most of the indexes that you're used to reading about are cap weighted, meaning the larger the stock is, the more it contributes to the performance of that index. And the analogy that I've been using here lately is take a basketball player, let's say Michael Jordan, since he's retired. Well, if the National Basketball Association said, well, Michael Jordan is so important, when he shoots a basket, we're going to make him, his baskets are going to count 6 points instead of 2. And if he shoots behind the 3-point line, we'll give him 9 points instead of 3. That's arguably how the indexes are weighted. They're weighted based upon the size of the companies. So what we're seeing is, prior to today, the top 7 stocks in the NASDAQ 100 make up 54% of that index's performance. And I guess NASDAQ has recognized that's just too much. We're going to wrap up by talking about some of the economic data that we see and discuss whether or not we're going to see a soft landing in the economy. However, before we do that, I would be remiss if I didn't encourage you to click the like button on this video and hit the subscribe button on the YouTube channel. We certainly appreciate that. And for those of you that are not familiar with our firm, Hicks & Associates Wealth Management serves individuals and families in a proactive approach. We serve our clients by being intimately familiar with their finances so that we can be proactive guides as they make financial decisions. And for most of our clients, we also serve as a portfolio manager, managing their investments in a truly active fiduciary and fee-based approach. If you want to learn more, feel free to drop us a line at hicks-associates.com. So let's talk a little bit about the economy and whether or not we are going to see a soft landing. Last week, we had the latest update on inflation, and the inflation data came in at 3.1%. Well, that is just barely above the 2.6% 10-year average and just a little bit above the 2 to 2.5% target that the Federal Market Committee has discussed is their goal. So next week, the Federal Reserve is going to be meeting again, and many believe that they are going to raise rates at least one more time. They really want to get inflation down at that 2 to 2.5% level. Well, the question is whether or not they're going to be able to do that. Are they going to be able to correct the high inflation without causing a recession? That's the question. And when you hear us and others using terms like soft landing, what we're talking about is that ideal scenario where the Federal Reserve can take some corrective action, and accomplish their mission without causing a recession. So on the screen right now is the GDP chart, and this data goes back quite a long ways, but we really just need to look at the right-hand side, and we can clearly see the trend over the last several quarters has been down. And so the question is, are they going to be able to correct the economy, get the inflation out of the economy without making that histogram go negative, without having the GDP turn negative? Now, this is the first 2 quarters of 2022 where we did see negative GDP, and so far the National Bureau of Economic Research has still not declared that was a recession. I don't know that I agree with that because there are 2 consecutive quarters of negative GDP. But for now, what we're looking at is whether or not the Federal Reserve is going to be able to correct the economy, get the inflation out of the economy without making the histograms go back into the negative. What they would really like to be able to see is they'd like to be able to see something like that, where the GDP still comes down a little bit, inflation comes down, as we've already looked at. They want to see that come even lower. But then we want to see the economic activity pick back up without reigniting the inflation. That's the objective. That's what they're trying to accomplish. So it remains to be seen on whether or not they will accomplish that objective or not, but keep watching the channel and we'll certainly keep you posted. That'll do it for this week. We certainly thank you for watching. Hope these videos help. And if there's anything that me or my team can do for you, whether it's asset management or personal financial planning, by all means, feel free to reach out to us. It would be an honor to see if we can be of service to you. Again, thanks for watching. We'll talk to you soon.